This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Big disappointment. Fewer jobs than expected were created last month, raising concerns about the economy and changing the conversation at the Fed.
Reversing course, stocks fell sharply, then staged their biggest upward reversal in 4 years as investors try to figure out how to invest in today's market.
Doing good. Meet the entrepreneur who had the bright idea to grow his business while giving back, one pencil at a time. All that and more tonight on Nightly Business Report for Friday, October 2nd.
Good evening, everyone, and welcome. A setback for the job market and an unusual day for the stock market. Today's employment report came as a surprise and not in a good way, stunning both Wall Street and Main Street. The U.S. economy added just 142,000 jobs in September, fewer than forecast. The unemployment rate held steady at 5.1%. And it wasn't just the September number. Results for prior months were revised lower, suggesting a downshift in job creation that began this summer. Hampton Pearson has more on this disappointing labor report.
American employers sharply cut back hiring in September, and the government revised job growth downward by 59,000 for July and August. Meanwhile, job growth for the last 3 months is averaging just under 167,000 compared to just under 200,000 per month for all of 2015, much to the surprise of leading Wall Street economists.
If you get a jobs report like this, then people are starting to think, geez, this could actually be a negative quarter.
It's hard to see anything good in those numbers.
The economy, I think, is clearly weaker than any of us would like it to be or thought it would be.
Headline unemployment remains at 5.1%, but that's because many Americans stopped looking for work and are not counted as unemployed. President Obama says economic weakness overseas is weighing on American job growth.
Although the American economy has been chugging along at a steady pace, much of the global economy is softening. We've seen an impact on our exports, which was a major driver of growth for us, particularly at the beginning of the recovery.
Reduced U.S. exports triggered significant manufacturing job losses last month. Oil drillers continue to lose workers due to sharply lower oil prices. Earlier this week, employers announced plans for nearly 60,000 layoffs in September. At the same time, job openings are at an all-time high, 5.8 million. September may be a reminder. It's still an employer's job market, and for the moment, some are on hold.
So job openings look very good, but as it turns out, the number of hires that employers are actually engaging in doesn't quite match that. So it's one of these sort of risk management things that companies really seem to be doing these days, is seeing a job that's open and then questioning whether they want to follow through with a hire.
Those with jobs worked fewer hours last month, and average wages are up just over 2% for the last 12 months. But Americans are spending more, boosting job growth at the mall and at bars and restaurants. For Nightly Business Report, I'm Hampton Pearson in Washington.
That weak jobs report may well change the timing of a possible interest rate hike by the Federal Reserve, which many thought would happen sometime later this year. Steve Leisman tells us why that is now in question.
It's the second straight jobs report under 200,000, and the first time that's happened since the spring. Wall Street commentary seems to suggest this number takes an October rate hike from the Federal Reserve off the table and even raises questions about whether the Fed will hike at all this year. Goldman Sachs says we now see a Fed rate hike in December as a close call. J.P. Morgan says they're sticking with December, but with less conviction. Over at Action Economics, they say their best guess is January. Now, some have reiterated calls for a rate hike further into 2016. Some of the words used, awful, lousy, and terrible, just some of the adjectives to describe the jobs report today, at least the ones that we can use on family television here. The Fed at its September meeting said the labor market was continuing to improve. The question is whether one bad report will change that outlook overall. St. Louis Fed President Jim Bullard said the Fed should concentrate on cumulative economic progress and not one report. The good news is that markets won't have to fret over Fed rate hikes for the upcoming October meeting if Wall Street is right about this. The next Fed worry moment now becomes November 6th. That's when the next jobs report comes, and we'll see if the current weakness does a three-peat. For Nightly Business Report, I'm Steve Leisman.
And now to our two guests for their analysis of the week jobs report. We've brought back Moody's Analytics chief economist Mark Zandi. He was with us last night, who's very upbeat about the jobs picture. And Lindsay Piegza is also with us. She's chief economist at Stifel Fixed Income and is a bit more bearish in her views on the labor market. Welcome to you both. It's a pleasure to have you here. Mark, I'm going to start with you because last night you were looking for 200,000 plus, and you were very upbeat on the jobs market. But not only did we miss on that number, but we had downward revisions in previous reports. Does that change your opinion of the market?
No, I do think the damage from the weak global economy, stronger dollar, lower oil prices, and just the volatility in financial markets is doing more damage to the labor market than I anticipated. But I view all those things as more or less temporary. And as we make our way to the end of the year into next, I think the underlying growth rate in jobs will reappear around 200K. I think abstracting from the vagaries of the data, that's roughly where they are. So my views have not changed as a result of this. I'm disappointed, but I don't think this changes the picture.
Lindsay, respond there to Mr. Zandi. Do you see it that way, or do you fear that this could be the start of something not so good?
Well, it was certainly a disappointing report, but I would actually argue that this has been a declining trend in the rate of hiring for quite some time. Remember, last year we were hiring at a pace well above 300,000. That slowed to 250, and now with this report, coupled with the downward revision to the previous month, we're now talking about an average of 167,000.
So what does that mean for economic growth and where you see it in this third quarter, well, the third quarter that just ended and in the fourth?
Well, a slowdown in hiring typically translates into a slowdown in economic activity. So for the second half of the year, we're looking for about 1.5% to 2% GDP. Still positive, but certainly not the 3-4% GDP that you would expect from an economy after 6 years of zero interest rate policy.
You know, Mark, we just ran that piece by Steve Leisman saying that now there are some who are questioning with the downward revisions in previous months whether or not the Fed will actually move this year. Lindsay's been on the record for several years now saying they're not going to move till 2016. Does it change your opinion?
No, I think December is still the most likely, although into 2016 is certainly plausible. I mean, I do think a necessary condition for them to actually raise rates is for my forecast of 200,000 jobs per month to be accurate and true, and that shines through by December. And it also is predicated on the expectation that the volatility in financial markets abates and that we have more stable conditions. So things have to come together. I think they will. So I think the most likely scenario is December. But, you know, I don't think I'd argue too strongly if it were January or sometime early in 2016.
Lindsay, soggy job numbers for September, downward revisions for August and July. The pace is clearly slowing. But what happens in October, November, December as so many companies add seasonal workers, whether it's UPS or Walmart or Target? Does that in and of itself help hiring?
Well, remember, we account for that with seasonal adjustments. So that's not going to play a major role here. And actually, if you want to look at the pace of seasonal hiring over the past several years, it's now being spread out into the third quarter as well. So actually, those seasonal adjustments may serve to undermine some of the more positive growth that we would see in the final quarter of the year.
When you look at the global environment, how healthy do you think it is? I mean, obviously, we've been the shining star of the global environment, but we also do not live in isolation anymore as an economy.
Exactly.
So when you look globally, how do things look to you?
Well, the Fed has been watching the international environment, and that has added another layer of concern of potential contagion then from the slowdown abroad. They're concerned about international volatility in equity markets. They're concerned about declining demand in commodity prices, essentially allowing us to import deflation. And of course, a rapidly rising U.S. dollar makes U.S.-made goods relatively more expensive, putting downward pressure on manufacturing and jobs creation here at home. So when we take a step back and we look at that very disappointing outlook, that sluggish activity level on the international plane, that's going to have compounding negative impacts here in the U.S.
All right. Thank you both very much. Have a great weekend. Lindsay Piegza and Mark Zandi with Moody's Analytics.
And on Wall Street today, investors witnessed the biggest upward reversal for stocks in, get this, 4 years. Equities plunged at the open along with bond yields on that weak jobs report, only to change course and end the day higher, much higher. The Dow Jones Industrial Average up 200 points after being down as many as 258. That's a 450-plus point move. The Nasdaq rose 80, the S&P 500 tacked on 27. Today's rally helped the three major indexes finish higher for the week, as you see right there, Part of the reason for the stock market reversal was a rise in domestic crude prices, which today settled up nearly 2%. And the yield on the 10-year note fell below 2%, tumbling as low as 1.9% this morning. Later in the program, our market monitor will help you figure out how to invest in this market, and he'll offer 3 picks.
And with the job report coming in weak, many are looking to the transport sector for clues about the health of the economy. Because when the economy does well, people and businesses tend to ship more things. And when it doesn't, the industry slows. Morgan Brennan takes a look at the message this sector is sending.
A disappointing jobs report from the Labor Department may be confirming what the transportation sector has been indicating for some time. U.S. economic growth is showing signs of slowing down. Transports have been long considered a gauge of economic health, since so many goods for so many industries must come in contact with a train, ship, or truck. Analysts say the sector has been telling a tough story all year.
It was certainly the first industrial-led recovery we've had since 1961 in this economy, from 09 through 14. But today we're seeing what appears to be the first industrial-led recession in a long time.
The prolonged downturn in the commodity complex has been weighing on stocks exposed to crude oil and other materials. Rail car loadings for Union Pacific, Norfolk Southern, CSX, Kansas City Southern, and Berkshire Hathaway's BNSF continue to disappoint, thanks to weakness in coal, petroleum products, and metals. Last week, commodity carloads were down 6%, marking the 29th straight week of declines. The commodity collapse and its effects on the industrial economy have also weighed on the less-than-truckload fleets that truck goods for multiple customers with one vehicle. LTL carriers deliver many industrial goods and raw materials. One reason, FedEx, which has a large LTL business, recently trimmed its earnings forecast.
But another more worrisome trend may be emerging. Data for trucking fleets that largely haul goods for consumers are starting to disappoint, suggesting that the part of the economy that has been holding up, the consumer economy, may be beginning to wane.
From the beginning of the year, we were also looking for the consumer to take that reduced cost of the commute, reduced cost of heating and cooling their house, and spend that money elsewhere. And we so far just have not seen that. It's been worrisome, troublesome, and as truck tonnage is continuing to tell us, the consumer's just not spending.
One area that's remained a bright spot is inbound container flows, or wares coming into the country through the ports, much of it in anticipation of the holidays. But as other transport data weakens and as the labor market shows signs of cooling, the question now, will the peak holiday season be as strong as everyone has been hoping? For Nightly Business Report, I'm Morgan Brennan.
Still ahead, the winds of change, one industry where demand for workers is on the rise, running counter to today's dismal jobs report. Retail brokerage firm Scottrade suffered a data breach. The discount broker said it believes its systems were attacked between late 2013 and early 2014. The hackers targeted client names and addresses. Scottrade says it is notifying 4.6 million customers and offering them identity protection services.
Employers may have added only 142,000 jobs last month, but there are some industries where jobs are on the rise, no matter which way the economic winds blow. Mary Thompson reports on the need for wind turbine workers from Sweetwater, Texas, in our latest installment of Where the Jobs Are.
Sweetwater made its name as a railroad hub, but it's banking on a future in wind. The more than 1,300 turbines dotting its skies mean plenty of work for turbine servicers like Shermco Industries, if it can find the workers.
We have the jobs, but we can't find the people.
The Bureau of Labor Statistics says jobs for wind technicians should grow an above-average 24% by 2022. Driving the increase, a rise in the number of turbines being installed as the cost of wind-generated electricity has dropped in half over the last 5 years.
When our students graduate, I would say almost about 98% of them play in place.
Heath Ince runs the Wind Energy Technology program at Texas State Technical College. He works with the industry to assure the 2-year program produces workers with the right skills.
They're looking for guys that can read schematics, they can have mechanical and electrical skills.
Those skills needed for years to come. Wind-generated electricity accounts for just under 5% of the U.S. total now, but is seen more than doubling to 10% by 2020.
It's a young industry, and it's something that's going to grow exponentially over the next 10 to 15 years.
33-year-old Harold Perigo left Pennsylvania for Texas and a career in retailing so he could study to be a wind tech. Along with plenty of work, being a wind tech pays well too, especially in markets like Texas, where Shermco CEO Ron Woodup says competition for talent is stiff.
You're coming in as an entry-level job, probably $40,000–$45,000 a year, and then there's an overtime element, and so you can very quickly get up to $60,000 or $80,000 a year. And then in a few years, it's not uncommon to get to 6 figures pretty quickly in this field.
The steadiness of the work and pay, a welcome change for 34-year-old Jeremy Brackenridge.
I'm making about 10% more than I was.
He's held a number of jobs, most recently in oil and gas. Laid off there, he's now training in-house at Shermco to become a technician, energized by the possibility of a future in wind. In Sweetwater, Texas, I'm Mary Thompson for Nightly Business Report.
And to learn more about the demand for wind turbine workers, read Mary's story on our website at nbr.com.
We begin tonight's market focus with reports that Sprint is planning major cost cuts. According to the Wall Street Journal, the wireless carrier could save $2.5 billion in costs. The cost cuts will result in some job reductions. The company currently employs more than 31,000 people. Shares rose almost 5% on that news to $4.25. The snack maker Mondelez is exploring a sale of several of its European businesses. That's according to a Reuters report. The company's cheese and grocery business in Europe could fetch around $3 billion in a sale. Shares rose 3% to $43.56.
Novocure is making its Wall Street debut today. The company, which makes a device to treat a form of brain cancer, priced its offering below the expected range and still saw its shares fall in their first day of trading. Despite the down day, though, the CEO is confident in the decision to go public.
And we want to be completely ready to bring this therapy to patients, not only in the U.S., but we've just started commercialization in Europe, and we just received our first approval in Japan. So again, markets will be choppy, they'll go up and down, but I think if we take care of the cancer patients, the stockholder's going to be in good shape in the long term.
Shares were off almost 17% to $18.28. United Airlines saw its shares fall as a union for maintenance technicians says the airline is dragging its feet in stalled talks. The union has been in negotiations with the carrier since November of 2012. The stock was off more than 2% to $51.76.
And now to our market monitor, who doesn't believe that the market is out of the woods just yet. So he's being, he says, selective and cautious with his buying. He's Jeff Sott, Chief Investment Strategist at Raymond James. Last time he was on, nearly 18 months ago, he recommended Dexcom, which is up 128%, and Johnson & Johnson, which is down 5%. Jeff, welcome. God, I didn't know it was that long. Do you still like both of those companies, Dexcom and J&J?
I do. I think that for conservative folks, Johnson & Johnson has a favorable rating from our analysts, and it has a nice portfolio of businesses. And Dexcom makes the best wireless glucose blood monitoring system on the planet.
All right, Jeff, so let's get to some of your picks. I hope I'm pronouncing this right. Stonemore Partners, LP?
Yeah, you know, bottoms tend to be a process, not an event. We had an event last fall on October 15th where you had a V-shaped bottom. But most of the time, you come down into a capitulation low, and then it takes 6 to 8 weeks to form a bottom. So we're not sure the bottom has been made. But if we are making a bottom, I'm going to be conservative with yield names. Stonemore is like a death stock. Cemeteries has a decent yield to it. Our analyst has a strong buy rating on it.
All right, let's move on to Genesis Energy LP. Tell me what they do and why you like them.
They are a midstream master limited partnership, so they're basically a toll taker. They don't have great price sensitivity to crude oil. The crude oil's got to go through the pipes. It's got to be stored somewhere. Grant Sims is the CEO. He's arguably the best CEO in the space. We think they're going to continue to increase their distribution, and our analysts like that one as well.
And Flaherty and Crumine Preferred Securities.
Yeah, Don Crumine is arguably the best straight preferred portfolio manager on the planet. He ran portfolios for Charlie Munger and Warren Buffett in the preferred space. He's got 2 closed-end funds that are trading at a discount to their net asset values with really decent yields.
Let's turn back to the market more broadly after today's jobs report. Are you optimistic that the market could end the year higher, even though in this most immediate term you describe yourself as selective and cautious? What do you think?
Yeah, well, I mean, our models turned cautious in the first part of July. We said the markets were going into a period of contraction. I didn't think it would be this deep. I do think we've made a capitulation low on the 24th and 25th of August. So if I had to bet, I would bet stocks are higher by year end rather than lower.
And what does the Fed do and when?
You know, I think that the when it does it is not the important. I think it's the trajectory and the pace of rate increases. My model has always called for a November increase, even though there's no FOMC meeting. That's certainly an out-of-consensus call.
It sure is. Well, we'll have to have you back in November then, Jeff. We don't want it to be this long again. Thanks so much for joining us, Jeff South with Raymond James. Coming up, pens, pencils, and paper clips. Meet the entrepreneur who's making back to school cool and giving back in the process. This month's Bright Idea is next. Here is what to watch next week. On Thursday, the Federal Open Market Committee will publish the minutes of its September policy meeting, and Wall Street will be watching. On the data front, a report on international trade, consumer credit, among others, and Alcoa will report its earnings, marking the unofficial start to the earnings season. And that is what to watch next week.
All right, we talk about it every year. Parents can spend $200 or more per child on school supplies, those who can afford supplies, that is. Teachers also spend money out of their own pockets, $500 on average. That's why one company got the bright idea to help families get some newer, funkier school supplies into the hands of young students who need them.
Good morning, everybody.
At the Camino Nuevo Charter Academy, in a part of Los Angeles where the median income is less than $28,000 a year, Ido Leffler's school supplies are a welcome gift.
Who loves crayons?
Leffler got the idea to help after shopping with his own kids back in 2013.
They basically ignored the school supplies aisle. If I'm not excited about what's in the aisle and my kids aren't excited about what's in the aisle, that's low-hanging fruit. So we decided to funk it up a little bit.
His company, Ubi, didn't invent binders and pencil cases, it redesigned them. Bright colors, tactile textures, jumbos, and minis. The products are fun, but Ubi is serious about its mission. For every item it sells, it donates one. For a while, Leffler could have used that kind of help when he was growing up in Australia.
I know what it's like for my mother as a school teacher to pull money out of her own pocket to buy supplies.
His dad's real estate business had failed back in the 1990s. Things are just fine now, and Leffler has started several companies. His Yes To is a hit in the all-natural beauty product space, which helped get him a meeting with a contact at Target to pitch Ubi.
I said to her, would you like to turn around and to see the product? And she looks at me and looks me straight in the eye and says, Ido, I don't have to. We're going to impact millions of kids. Let's do this. And boom.
Boom is right. Ubi launched in June 2014 and did $20 million in sales in a year. Its donations have impacted more than 1 million students. Still, some wonder how effective the buy one, give one model can be.
One of the big criticisms of the model is that it doesn't address the root causes of the social issue.
Cornell University's Chris Marquis has written about how companies like Tom's Shoes and Warby Parker with its eyewear have addressed symptoms without actually solving any problems. Raising awareness is a plus, but to be successful, the cause has to resonate with consumers, and the price point has to make sense for the companies.
There's a lot of research that shows that younger consumers actually want to give back. They want to actually have some sort of social impact. So I think that actually this market will continue to grow.
The first thing we need to do is make her a UB teacher.
UB also helps teachers like Camino Nuevo's Maria Cortez, who spends a lot of her own money on supplies for her students.
Over 1,000 a year. This is so awesome. For them, what it means is that they are valued, right? Like our classroom is valued, our school is valued, their work is valued. And I tell them they are the leaders of the future, and UB is really supporting that for our children.
After all, it's teachers like Cortez and Ido Leffler's mom who can inspire students to put themselves into the equation when it comes to solving the problems of the future.
It doesn't really matter what widget you're selling. If you've got a cause that everybody is fully committed to, then you're able to do things that really translate to magic.
UB even caught the attention of the entertainer Usher, who chipped in and helped design a new line this year and also participated in one of UB's giveaway events at a different school in Los Angeles back in May. More and more companies and more customers want their purchase to be linked to a purpose.
To a purpose, absolutely. Well, good for him, because, you know, the start of the new school year should be one that's positive for kids, I think. That helps. That does it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And thanks from me as well. Have a great weekend, everybody. We will hope to see you right back here on Monday.